What if the biggest shift in the silver market wasn't a price breakout, but something happening behind the scenes that most investors still haven't noticed? What if the headlines everyone is watching are actually distracting them from a much larger transformation that could reshape how silver is bought, sold, and valued for years to come? And what if, while retail investors are debating whether silver is going to move $5 higher or lower, the world's largest institutions have already started positioning for a completely different future? I'm John, and today we're going to connect a series of events that, on their own, may not seem extraordinary. But when you place them together in the right order, they paint a picture that deserves every silver investor's attention. For years, the silver market has lived with one major contradiction. Physical demand has continued growing, while price action has often failed to reflect that demand. Manufacturers have needed more silver. Solar companies have needed more silver. Electronics producers have needed more silver. Central banks have continued increasing their focus on hard assets through gold accumulation, indirectly reinforcing confidence in precious metals. Yet silver has repeatedly struggled to behave the way many investors expected. That disconnect has frustrated long-term holders for decades. The obvious question becomes why. Was industrial demand overstated? Was investment demand weaker than reported? Or has the market itself become so dominated by financial products that the actual movement of physical metal has become only one part of the pricing equation? This is where recent developments become extremely interesting. Over the past several weeks, several changes have emerged that individually might appear routine. Exchanges have adjusted trading rules, institutions have continued requesting physical delivery. Large bullion flows have quietly shifted between vaults. Governments have continued discussing supply chain security for critical minerals. None of these events, standing alone, would necessarily suggest a major turning point. Together, however, they begin telling a different story. Silver today is no longer viewed simply as a precious metal. It has become an industrial necessity. Every new generation of solar technology depends on it. Electric vehicles require it. Advanced semiconductors rely on it. Artificial intelligence infrastructure, data centers, medical equipment, military electronics, aerospace manufacturing, telecommunications, and high-performance electrical systems all consume silver because of one simple fact that hasn't changed for centuries. Silver remains the most conductive metal on Earth. There is no financial opinion attached to that statement. It is simply physics. That means every country attempting to modernize its energy infrastructure eventually arrives at the same conclusion. They need silver. And unlike many industrial materials, increasing silver production isn't something miners can simply decide to do next quarter. Nearly 3/4 of global silver production comes as a byproduct of mining other metals such as copper, zinc, and lead. If those mines slow production because of weak demand in their own markets, silver supply also slows even if silver prices themselves are rising. That creates an unusual supply dynamic. Higher prices don't automatically create higher production. Few investors fully appreciate how important that reality has become. Now consider another development. Several industry reports have continued highlighting structural deficits in the silver market. For consecutive years, fabrication demand has exceeded newly mined supply after accounting for recycling. While inventories and above-ground stocks can help bridge temporary shortages, they cannot expand forever if demand consistently exceeds fresh production. Imagine draining water from a reservoir slightly faster than rain can refill it. At first, nothing appears unusual. Water levels remain comfortable. Then, over time, the decline becomes impossible to ignore. Markets often work the same way. Pressure builds quietly, then suddenly. But before assuming that automatically guarantees dramatically higher prices, we need to separate physical fundamentals from financial pricing mechanisms, because these are not always the same thing. This is where many newer investors become confused. They hear about physical shortages and expect immediate price explosions. Instead, they see silver moving sideways for months, sometimes even falling. That creates frustration. Yet experienced market participants understand something extremely important. Price is often determined at the margin. Not every ounce of physical silver changes hands every day. What changes every second are financial contracts, futures, options, exchange-traded products, institutional hedging, algorithmic trading, currency movements, interest rate expectations, dollar strength, bond yields, risk sentiment, liquidity conditions. All of these forces influence silver prices simultaneously. Sometimes industrial demand dominates. Sometimes monetary policy dominates. Sometimes investor psychology dominates. Understanding which force is currently in control separates emotional investing from analytical investing. Over the last several months, global investors have watched inflation cool compared with its previous peaks, while interest rate expectations have remained uncertain. Every Federal Reserve statement, every employment report, every inflation reading, and every Treasury auction has immediately influenced precious metals. Why? Because silver carries two personalities. One is industrial, the other is monetary. When manufacturing strengthens, industrial demand increases. When financial uncertainty rises, investment demand increases. Occasionally, both forces align. Those periods have historically produced some of silver's strongest bull markets. The question many professionals are asking today is whether the global economy is slowly moving toward another period where both sides begin supporting higher long-term demand simultaneously. If that happens, supply becomes much more important. Now let's look beyond North America. One of the biggest shifts occurring globally isn't necessarily happening inside New York trading hours, it's happening across Asia. Over the past decade, China has steadily expanded its precious metals infrastructure. Vault capacity has grown. Trading systems have evolved. Settlement mechanisms have improved. Domestic investment products have expanded. Refining capabilities have increased. These aren't overnight decisions, they're long-term strategic investments. Infrastructure like this isn't built for headlines, it's built for decades. Why would governments and financial institutions invest billions into expanding precious metals infrastructure unless they believed these markets would become increasingly important? That question deserves serious thought, because markets often reveal intentions through investment long before policies officially change. At the same time, another trend has quietly accelerated. Many investors have become increasingly interested in owning assets that carry minimal counterparty risk. That phrase sounds technical, but the idea is actually simple. If you own physical silver directly, your ownership doesn't depend on another company's balance sheet. It doesn't depend on a broker remaining solvent. It doesn't depend on another institution fulfilling a contract years from now. You either own the metal or you don't. That distinction becomes increasingly valuable during periods of financial uncertainty. This doesn't mean financial products are inherently bad. They serve important purposes. They provide liquidity. They improve accessibility. They help institutions hedge risk. But they're designed differently than physical ownership. Understanding that difference is becoming more important than ever. Meanwhile, institutional demand continues evolving in ways many retail investors rarely notice. Large market participants don't always announce their intentions through interviews. They often reveal them through positioning. Inventory movements, delivery requests, storage transfers, long-term procurement contracts, infrastructure investments. These actions frequently communicate more than press releases ever could. And that's exactly why recent developments deserve closer attention. Because the story isn't centered around one spectacular headline, it's emerging through dozens of smaller signals that, together, point toward something much larger taking shape beneath the surface of the global silver market. Most investors are still watching daily price candles. The institutions appear to be watching the plumbing underneath the entire system, and history has repeatedly shown that when the foundation begins changing, the visible market often reacts much later than people expect. The real question isn't whether silver will experience another volatile week or another volatile month. The real question is whether the market structure itself is slowly evolving into something fundamentally different from the one investors have known for the past 20 years. Because if that answer is yes, then what happens next may have far less to do with short-term speculation and far more to do with how the world's largest economies choose to secure one of the most strategically important metals of the modern age. One of the biggest mistakes investors make is assuming that a market changes only after prices explode. In reality, the most important changes usually happen long before the chart captures everyone's attention. By the time a major breakout appears on financial television, institutional money has often been positioning for months, sometimes even years. Think about every major commodity cycle in history. Oil didn't suddenly become important when prices surged. Copper wasn't suddenly critical when it reached new highs. Uranium wasn't suddenly valuable the day investors started talking about nuclear energy again. In every case, the underlying fundamentals shifted quietly first. The price simply caught up later. Silver may be entering a similar phase. Let's step back and ask a simple question. If governments around the world are investing hundreds of billions of dollars into modernizing electrical grids, expanding renewable energy, Building artificial intelligence infrastructure, upgrading military technology, and reshoring semiconductor manufacturing, what material connects nearly every one of those industries? The answer isn't difficult. Silver. Modern civilization depends on electricity, and electricity depends on conductivity. Every improvement in energy efficiency, every increase in computing power, every expansion of communication networks eventually leads back to materials capable of transmitting electricity with minimal resistance. That places silver in an unusual position. Unlike luxury commodities whose demand depends largely on consumer spending, silver sits at the intersection of technology, manufacturing, national security, and monetary confidence. Very few assets occupy all four categories simultaneously. Now consider what has been happening inside manufacturing itself. Around the world, countries are becoming increasingly concerned about supply chain resilience. The disruptions experienced over recent years forced governments and corporations to rethink a strategy that prioritized efficiency above everything else. Today, resilience has become equally important. That means companies are increasingly willing to hold larger inventories of critical materials rather than relying entirely on just-in-time deliveries. For decades, inventory reduction was considered good management. Now strategic inventory has become a competitive advantage. That shift may sound subtle. It isn't. Because every additional ounce sitting inside a warehouse is one less ounce immediately available to the open market. Multiply that behavior across thousands of manufacturers, and inventory begins disappearing much faster than production statistics alone would suggest. Then there's another factor that rarely receives enough attention: mining investment. Bringing a new silver-producing project into operation is not like opening a new retail store. It often takes years. First comes exploration, then environmental studies, permitting, infrastructure construction, financing, engineering, equipment procurement, labor recruitment, commissioning. Only then does meaningful production begin. In many jurisdictions, that process can easily stretch close to a decade. Markets, however, don't wait 10 years. Demand changes every quarter. That's why commodity markets frequently experience long periods of apparent stability followed by sudden shortages. Production simply cannot respond quickly enough. And this brings us to another fascinating development. Institutional investors have increasingly begun separating price volatility from long-term value. Those two concepts are often confused. Volatility measures movement. Value measures importance. An asset can be extremely volatile while becoming increasingly valuable to the global economy. Likewise, an asset can remain relatively stable while quietly losing long-term relevance. Professional investors spend far more time studying structural demand than daily headlines. That's one reason why warehouse data, delivery statistics, industrial consumption, and refining capacity often receive far more attention inside institutional research departments than they do on financial television. Now let's talk about something many viewers overlook completely: the difference between trading volume and physical ownership. Every day, enormous volumes of silver-related financial contracts change hands across global exchanges. Yet only a relatively small percentage results in physical metal changing ownership. Most contracts are opened, closed, rolled forward, offset, or settled financially. This is completely normal. That's how futures markets are designed to function. But occasionally something changes. Instead of closing contracts, more participants begin requesting actual delivery. Why does that matter? Because delivery requests remove uncertainty. A futures contract is an agreement. A delivered silver bar is an asset. When delivery activity begins increasing during periods of elevated industrial demand, analysts start paying closer attention, not because it guarantees shortages, but because it may indicate changing investor preferences. Some institutions simply prefer owning the metal itself. Others may require physical inventory for manufacturing. Still others may be hedging long-term operational needs. The motivations differ. The result is the same. Physical inventories become increasingly important. Now combine that with another trend unfolding globally. Central banks have continued adding gold reserves at historically elevated levels over recent years. While central banks generally don't accumulate silver in the same way, their continued preference for hard assets sends an important message. It reflects growing attention toward monetary diversification. When sovereign institutions increase exposure to tangible assets while reducing dependence on financial promises, investors naturally begin asking similar questions. Not because central banks predict tomorrow's prices, but because they often prepare for tomorrow's risks. That distinction matters. Preparation and prediction are not the same thing. Good risk management rarely depends on knowing exactly what happens next. It depends on being prepared regardless of which outcome unfolds. That's precisely why sophisticated investors spend so much time analyzing scenarios instead of making absolute predictions. Let's examine another piece of the puzzle: currency markets. Silver doesn't trade in isolation. A strengthening US dollar often creates headwinds for precious metals. A weakening dollar can provide support. Interest rates influence borrowing costs. Bond yields affect opportunity costs. Inflation shapes purchasing power. Economic growth changes industrial consumption. Investor sentiment determines capital flows. Every one of these variables influences silver simultaneously. That explains why silver sometimes falls even when demand appears healthy, and it explains why silver occasionally rallies despite disappointing economic news. Markets constantly weigh dozens of competing forces. The strongest narrative isn't always the one determining today's price. Sometimes liquidity dominates, sometimes monetary policy dominates, sometimes geopolitical uncertainty dominates. Understanding which force currently holds the greatest influence is one of the hardest parts of precious metals investing. Now ask yourself something. What happens if several supportive forces begin aligning at the same time? Imagine industrial demand remaining strong. Imagine infrastructure spending continuing. Imagine manufacturing inventories staying elevated. Imagine monetary uncertainty increasing. Imagine investment demand improving alongside industrial demand. Would supply be able to respond immediately? History suggests probably not. That's exactly why experienced commodity investors pay close attention before shortages become obvious. Once shortages dominate headlines, much of the easy opportunity has often already disappeared. But there is one final development that deserves careful attention. It has nothing to do with daily price charts, nothing to do with television commentators, nothing to do with social media excitement. It has everything to do with confidence. Financial systems ultimately function because participants trust them. Markets function because buyers trust sellers. Banks function because depositors trust banks. Currencies function because societies trust monetary systems. That trust is one of the most valuable assets any economy possesses. When confidence is abundant, financial assets generally perform well. When confidence begins weakening, investors naturally seek diversification. Some choose bonds, some choose cash, some choose real estate. Others begin looking toward tangible assets that cannot be digitally created, diluted, or printed into existence. That's why silver has occupied such a unique place throughout financial history. It isn't merely an industrial metal. It isn't merely a precious metal. It sits directly between both worlds. And that dual identity may become increasingly important as the global economy enters its next chapter. Because while millions of investors remain focused on whether silver finishes this week $1 higher or $1 lower, something much larger appears to be developing beneath the surface. The institutions aren't just watching prices anymore. They're watching inventories, supply chains, strategic reserves, delivery patterns, infrastructure investments, manufacturing demand, settlement systems. And when that many pieces begin moving together at the same time, history suggests the next major chapter in the silver market often begins long before the majority of investors realize the story has already changed. If you've stayed with me this far, you've probably realized this discussion has never really been about whether silver goes up tomorrow morning or next month. It's about recognizing whether the market beneath the price is quietly changing before everyone else notices. History repeatedly teaches the same lesson. Financial markets rarely announce major turning points in advance. They leave clues, small clues. Warehouse inventories begin behaving differently. Institutional positioning slowly changes. Governments adjust regulations. Industrial purchasing patterns evolve. Settlement systems expand. Infrastructure investments accelerate. Individually, none of those events usually make headlines. Collectively, they often become the roadmap of the next decade. And that's exactly why recent developments deserve far more attention than the daily noise surrounding short-term price movements. One of the most overlooked concepts in investing is that price and value don't always move together. Sometimes prices run far ahead of reality, other times they lag behind it. The dot-com bubble was one example. The housing boom before 2008 was another. Commodity markets have experienced similar periods throughout history. There were years when uranium remained ignored despite improving fundamentals. Years when oil traded at prices few thought were possible. Years when copper quietly tightened before manufacturers suddenly found themselves competing for available supply. Markets don't move because everyone suddenly agrees. They move because expectations eventually collide with reality. Silver has always been a market driven by expectations. Some investors view it primarily as a monetary asset. Others treat it as an industrial commodity. Some simply trade momentum. Others hold it for decades as long-term insurance against economic uncertainty. Those different motivations create one of the most fascinating markets in global finance, because every participant is responding to a different set of variables. Industrial companies focus on production schedules. Manufacturers focus on procurement costs. Investors focus on inflation. Central banks monitor currency stability. Governments think about strategic resources. Mining companies analyze production economics. Fund managers examine liquidity. Retail investors often focus on headlines, yet all of them ultimately participate in the same market. That's why silver often appears confusing. Different buyers enter for completely different reasons, but occasionally something unusual happens. Those motivations begin pointing in the same direction. Industrial demand strengthens, investment demand improves, supply growth remains constrained, strategic inventories increase, financial uncertainty rises, infrastructure spending accelerates. When multiple forces begin aligning instead of offsetting one another, markets often enter entirely new phases. No one can predict exactly when that transition occurs. Anyone claiming to know the exact day or exact price is usually selling certainty that simply doesn't exist. Real market analysis isn't about certainty, it's about probabilities. It's about recognizing when the balance of evidence begins shifting. And today, the evidence deserves serious attention. Let's examine one final question. Why are so many major economies suddenly talking about securing critical mineral supply chains? Because resources have become geopolitical. The world is entering an era where technological leadership increasingly depends on reliable access to strategic materials. Semiconductors require specialized metals. Electric grids require enormous quantities of conductive materials. Artificial intelligence requires data centers consuming unprecedented amounts of electricity. Defense systems require highly reliable electronic components. Renewable energy depends on expanding transmission networks. Every one of those trends intersects with silver in some capacity. That doesn't automatically mean prices move vertically tomorrow. Markets rarely behave that neatly. But it does mean silver's strategic importance appears to be increasing rather than decreasing. And that's a very different conversation from simply asking whether today's chart looks bullish. Another development deserves attention. Institutional investors have become increasingly patient. Contrary to popular belief, most large funds don't attempt to buy everything after headlines become exciting. They accumulate gradually, sometimes over many months. They diversify. They manage risk. They scale positions according to changing conditions. This behavior often creates a misleading impression for retail investors. People assume nothing important is happening because prices haven't exploded. Meanwhile, institutional positioning may already be evolving beneath the surface. That's why experienced investors often spend more time following capital flows than social media excitement. Money usually leaves footprints. You simply have to know where to look. Warehouse transfers, refining capacity, long-term procurement agreements, mining investment, infrastructure spending, strategic reserve policies, government legislation, corporate earnings calls. These sources frequently reveal more about the future than emotional market commentary, and perhaps that's the biggest lesson of all. Markets reward preparation, not reaction. By the time everyone agrees that something extraordinary has happened, extraordinary opportunities often become much harder to find. That's true across nearly every asset class. The investors who recognized personal computing before it became mainstream. The investors who understood smartphones before everyone owned one. The investors who saw cloud computing transforming businesses. The investors who recognized artificial intelligence before it dominated headlines. None of them possessed perfect foresight. They simply identified structural trends before consensus formed. Silver deserves to be analyzed through that same lens. Forget next week's candle. Forget tomorrow's volatility. Forget the emotional debates that dominate financial television every afternoon. Instead, ask yourself larger questions. Is industrial demand becoming structurally stronger? Are governments treating silver as a more strategic resource? Are infrastructure investments increasing globally? Is mine supply capable of expanding fast enough? Are institutions paying greater attention to physical ownership? Are global financial systems slowly diversifying toward tangible assets? Those questions matter far more than whether silver closes 50 cents higher this Friday. Because structural trends shape years, daily headlines shape hours. As investors, our responsibility isn't to predict every price movement. It's to recognize when the underlying environment begins changing. And based on everything we've examined today, from industrial demand and supply constraints to infrastructure expansion, institutional positioning, global strategic investment, and the growing importance of physical assets, the silver market appears to be entering one of the most interesting periods it has faced in decades. Does that guarantee dramatically higher prices? No. Markets never offer guarantees. Unexpected economic slowdowns, changing monetary policy, stronger currencies, technological substitutions, or shifts in investor sentiment can all influence future performance. Risk never disappears. It only changes form. That's why successful investors remain flexible. They question assumptions. They study evidence. They avoid emotional decision-making. Most importantly, they continue learning even when everyone else believes the story is already finished. Because the biggest financial opportunities rarely begin with fireworks. They begin quietly. One inventory report, one infrastructure project, one policy adjustment, one delivery trend, one shift in institutional behavior, then another, until one day the market suddenly reacts and everyone wonders where the move came from. The reality is that it didn't come from nowhere. The evidence had been building for months. The signals were there. Most people simply weren't looking. I'm John, and this is AG John Silver Update. If you enjoy deep, fact-based analysis of the silver market without sensationalism or hype, make sure you're subscribed. I'd also like to hear your perspective in the comments. Do you believe silver is gradually entering a completely new phase driven by industrial demand and strategic investment, or do you think the market is still years away from its next major cycle? Thanks for watching, and I'll see you in the next analysis.